Good day, traders. Today I'm going to talk about New York close trading, and probably one of the best videos that you're going to watch if you're a part-time trader or an end-of-day position trader. Stay tuned. We'll be right back. Good day, traders. Stacey Burke from Stacey Burke Trading, and today I'm going to go over the New York close, one of my basic New York close trading strategies. I'm going to encourage you to really take a look at this. This could be a really powerful lesson regardless of what time frame you're learning, but some very basic, simple strategies that I employ week in and week out that have paid some big dividends. So we're using New York closing data. If you haven't got New York close charts, I'm going to encourage you to look at that no matter what instruments you're trading. Even if it's currency, you want to try and use the New York close charts. They're probably the most accurate. And the reason why that is that realistically, currency markets open up in Asia, then Frankfurt and London come on board, and then as New York comes on board and London closes, New York closes, that's traditionally the end of that 24-hour trading session in terms of the banks and the large traders. And then we start again from Asia as the sun comes around the globe. So use the New York closing price action. Now I'm going to suggest to you, and you can go and take, after you've watched this video, go and check this out for yourself. If you're not using end-of-day trading because it's too slow or too boring or too hard, really pay attention today. Start, even if you're just tracking one or two pairs, start to keep a diary of following these pairs and watching what you see. So I'm going to give you some tidbits today. Start tracking it and find out for yourself, but I'm going to suggest to you that at least two of the weeks out of the 4 per month, you're going to get some ideal low risk asymmetrical trade opportunities with some signal bar setups to position yourself with a 1 bar stop for potentially 2 times or greater reward to risk trading opportunities. Now you're going to make mistakes. We'll talk about that soon, but I'm going to suggest to you to really start tracking this and to step back and look at where some of these larger ranges are showing up and opportunities for you as a trader. Now there's obviously three types of opportunities, or 3 types of movement that the market will do. It'll usually be trending, it'll enter into a range, or it'll start or trend in reverse. So now you've heard me say this in other videos, I don't often trade on a Monday. The reason I've done that is that through my own back testing and the way that I'm trading, I found that I like to see the smart money position themselves on a Monday and show their hand. So often I found that Monday will confirm or raise into question the direction that the institutional money is moving. And oftentimes with any of the trade setups, usually Tuesday morning with a limit order or a momentum order, there's always an opportunity to enter the market on the Tuesday without having any difference from being in the market on the Monday. So basically on a Monday, I felt that oftentimes there was not necessarily the conviction the same as it is on a Tuesday, and the same opportunity existed to get a good fill or the same fill. So before we go to the next part, I want you to go to your end-of-day charts, look at your weekly and your monthly ATR, your average true range, and start to, if you're not trading, position trading end of day or on longer term charts, take a look at your average true range. Even if you're day trading, you should know this for your daily range. It gives you an idea on average where the market trades in terms of its movement. And so for example, if we're going to position ourselves maybe during the week on one of these signal bars, we want to have hypothetically an idea of where the market might start to show the end of its move in terms of its average range. Now if it's a trending market or it's a very strong trending market, then I'm looking at my monthly ranges and my previous month's highs and lows for areas where that market might be seeking orders to fill. Okay, so now signal bars. So what we're looking for are inside bars, pin bars, and engulfment key reversals. Now regardless of what you've seen before, I want you to go back, and even if you go back and just go bar by bar, which I'm going to encourage you to do your own back testing. I don't trade on Monday, and I'm going to suggest to you that, again, at least 2 times out of the 4 weeks, you're going to see an ideal signal bar in terms of an inside bar, pin bar, or an engulfment key reversal, where the market will give you a high possibility asymmetrical trade opportunity to enter on the break of one of these bars, and then position yourself a stop on the opposite end of that bar to go in line with the movement of the market. So if you have a limit order and the market picks you up on the way, and it's an OCO or a standing order to have the stop automatically triggered when your market order is, or your limit order is picked up. And then depending on what type of trade setup it is, if it's a range trade, you may want to look at setting a target. Again, for me, if it's a momentum trade, I don't often set targets. I'll wait till the price action has given me an indication to either move my stop or to exit the market as it's blowing off in one direction or the other, or exhausting. So the key is, though, very rarely, if ever, do I ever have more than that 1 bar as a stop loss. Now, that is not the only way that I trade, but through your diligent study of following this price action, like that will take you 2 minutes a day, even if you're just following one instrument, but I'm going to suggest to you, you're going to get some high opportunities. Now, if you understand this, if each instrument offers a couple of really good setups a month and you're following 10 different pairs, there's plenty of trades. Now, there are lots of trade opportunities that are going to show up that are with these signal bars. So, minimum I'm looking at is risking 1R, sorry, the maximum, but the minimum reward is always 2 to 1. So what that means is that, for example, if I'm getting an order to sell, now even with if you start doing measured movements, that bar itself, so if you're risking 80 or 90 pips, you want to be looking at 180 pips of profit. So if you can project that 180, you want to be able to identify that 180 with another level potentially of resistance or support where the market could exhaust itself. So you want to know, is there room for that market to move? But the key thing is that you're not trying to take every signal. What I'm trying to suggest to you is to start getting in rhythm with the market. You want to be looking to your left at the previous week. Who was in charge? Did bulls have a breakout trade, and were they successful, or were they trapped and then the bears reversed it? Are we in a strong downtrend, a strong uptrend? I'm not suggesting to try and hit every single trade. What I'm suggesting to you is to be looking for these high probability signal bars when they present, to be able to position yourself with a low risk asymmetrical profitable opportunity, because they do show up, and sometimes they show up a lot more than twice a month. Now, you are going to make mistakes, but this is why I'm encouraging you right now to be journaling this every single day, and you'll realize that like you might be trying to scrape out 20 pips or 100 pips on your hourly or 4-hour charts or 5-hour or 5-minute, and I'm not suggesting that that's not a good thing to do, because if you're making money and you're profitable with your trading, then by all means continue it. But what I am suggesting is that if you're struggling, step back, get off the charts, look at these longer term time frames. The smart money and the institutional money are positioning, they're building positions throughout the day on these longer term trends. And it's that building of these positions that drives the market and the order flow. So it's misleading sometimes. There's a misconception out there that you need to be on these shorter time frames to make the money, and that's often what they want you to believe. The shorter the time frame that you go to, the less the odds are in your favor. So if you step back and you look at the longer term time frames, you're going to realize that you can position yourself. The spreads become irrelevant because you're talking about maybe 700, 800, 900 pip ranges over on the month, and 300, 400, 500 pip ranges on a week, depending on which instrument you're looking at. So these 2 or 3 or 4 pip spreads are irrelevant. And if you can start to master that price action, you're going to step back and start trading with the real movement of the institutional money. So follow these signal bars. Look at how they present in terms of the price action based on what's happened to the left of your screen. You're trading to the right, so you always want to manage your downside You want to look a minimum of 2 times your risk. And hopefully it's going to be a lot more than that if you're looking at the opening ranges of the month and the range of the average true range of the month. You're going to make mistakes. Journal everything that you learn and keep getting better. So hopefully you got some value out of today's video, traders. I cannot emphasize to you enough, step back, get on the end of day charts. There are some massive opportunities for traders, and there's going to be thousands more trades. So always manage the downside. Every single trade is just another trade. Act in your own best interest, and stay disciplined, stay focused. Have a great trading week. Thanks, traders.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.